Thank you. Good afternoon, everyone. On behalf of Porter Services, I welcome all the participants to the Apar Industries Q1 FY21 earnings conference call. Today on the conference, we have Mr. Kushal Desai, Chairman and Managing Director, Mr. Chaitanya Desai, Managing Director, and Mr. V.C. Devakar, CFO of Apar Industries. I would now like to hand over the call to Mr. Desai for his opening remarks. Over to you, sir.
Thank you, Mr. Jain. Good afternoon, everyone, and a warm welcome to our Q1 FY21 earnings call of Apar Industries. At the outset, I hope that your families are all safe during this strange period. I will start the call with giving a quick industry update and then an overview on the performance of each of the segments. And after that, we can open the floor to questions. So as we all know, Q1 FY20 saw this national lockdown in April, and it was followed by a graded resumption of operations by the end of May. After that, the operations have been at lower than normal levels due to various requirements of safe distancing and other measures being taken from this COVID-19 pandemic. Even as the economy has opened up, there were issues with migratory labor and transportation issues, especially at the end of May and the beginning of June, and then it has been slowly alleviated as time has passed by. However, many of our customers have faced delays in financial closures of their projects as well as operating their project sites, and this has further impacted sales during the quarter. So in Q1 FY20, Apar posted consolidated revenues of about 1,293 crores, which is about 35% lower than that in the previous year. And we had an EBITDA profit of rupees 35 crores, but an overall loss after tax of 23 crores. The profitability, of course, is impacted by lower volumes and other COVID-related costs, such as idle overheads, price variation, etc. We expect the profitability to improve in the second quarter, where a lot of our cost reduction initiatives have also taken root. There will also be a lower share of higher priced inventory, etc. in the case of our oil business, which is now pretty much reduced. And our increased focus on exports has led to an export revenue growth in the quarter of 11% compared to that of the previous year. So even though overall sales were down by 35%, export revenues were higher by 11%. I'd like to cover a few highlights in the transmission and distribution sector in general. T&D orders of over 10,000 crores were received in the quarter by key players, and this is much lower than in Q1 FY20. The DISCOM stress continues to be challenging. DISCOM owe 1.33 trillion to various power generation firms as of June 2020, and that's 47% higher than in the previous year. DISCOM cash losses are expected to almost double to about 58,000 crores in FY21. There has been a slow offtake of loans as part of the liquidity support of rupees 90,000 crore infusion by PFC and REC, which has been announced in the month of May. The Power Minister has also proposed a new scheme worth rupees 3 lakh crores spanning over 5 years to the Finance Commission to restructure the power system to make states responsible for the financial health of their DISCOMs. There is a very urgent need for immediate structural reforms, and we are hopeful that the government will focus on some of these in line with what they did in the agriculture sector during the lockdown. In Q1 FY21, India has added 1,091 circuit kilometers of AC transmission lines. So this is about 48% lower than in the same period previous year. And 7,390 MVA of AC substation transformation capacity, which is 41% lower than in the previous year. Transmission and distribution demand will be fortified from the ISTS and the renewable transmission projects, which we expect will start getting executed in the near future. While in Q1 FY21, no new TBCB transmission projects were awarded, there are currently 22 transmission projects under construction which are worth more than 26,000 crores. The Indian Railways has fixed a target of electrification of 7,000 railway kilometers for the year 2021. All routes on the BG network, broad gauge network, have been planned to be electrified by December 2023, and that target doesn't change. 365 kilometer major connectivity work has been commissioned during the COVID period. In general, it has been our observation that the government sector and various government departments have not been able to adopt like their private enterprise counterparts to cope with the new work conditions imposed from this COVID situation. It has thus slowed down tendering and awarding of contracts because physical meetings have not been happening, and in virtual meetings, finalization of tenders and contracts have not been taking place. Also, payments and some of the production facilities like in the railways for locomotive manufacture and the coach plants have taken very long to ramp up and still continue to run at capacity levels which are much lower than pre-COVID levels. However, we hope that in Q2 and Q3 there will be an improvement. Our personal opinion is that Q3 and Q4 is the period where we will see a ramping up of operations. In terms of briefing you on each of the segments' performance, I'll start with the conductor segment. Our conductor business declined 31% year-on-year to reach 709 crores in Q1 FY20, mainly due to a 52% year-on-year decline in the domestic revenues. Export revenues grew 26% in the quarter, contributing to 53% of the overall revenues. Volume fell by 24% to 31,861 metric tons. The EBITDA per metric ton post-forex adjustment came in at 6,185 rupees compared to 12,137 in Q1 FY20. This was primarily due to approximately 16 crores of costs incurred arising of various reasons triggered by COVID-19. This includes export benefits of 7.5 crores on account of duty-free material, which we will realize in the ensuing quarters. So of the 16 crores, 8.5 crores is non-retrievable and 7.5 crores is something that will creep in over the next few quarters when the duty-free material is consumed. Our higher value products, which is our high efficiency conductors and copper conductors, contributed to 38% of revenues. This includes 24% from copper conductors and 14% from the high efficiency conductors. Progress on the recently introduced copper transpose conductors for transformers has also been slowly gaining approvals in spite of the current market conditions. We expect that by the fourth quarter of this year, a lot of the approvals which we seek will be in place, and in FY22 we should start seeing significant contribution coming from this investment that we've made. Our aluminum rods also saw a good export demand. New order inflows came in at 317 crores, which is down 47% year-on-year due to both customer execution issues and delay in awarding new tenders, as I had mentioned earlier. The order book at the end of June 2020 stands at 1,573 crores. In terms of our specialty oil division, our revenue declined by 43% year-on-year to 352 crores. Volumes came in at 61,624 KL, which is 42% lower than in the previous year. The auto lubes and industrial oil business contributed to 23% of the revenues. We saw good demand for auto oils from the tractor OEMs and from the agriculture sector that picked up from the last week of May 2020. Exports contributed to 49% of the revenues for the quarter compared to 36% in Q1 FY20. Our Hamria plant has run uninterrupted through the entire COVID period. The plant utilization, however, was at 55%. even though there were no lockdowns and no production days that were lost there, due to global lockdowns in most countries, dispatches were affected in April and May as customers asked to hold shipments due to congestion in various ports. However, having said that, they have picked up considerably in June, and the company carries a good order book in Hamriyah for the months of July, August and September. We expect better demand globally in the second quarter of FY21 for the oil business, and we also expect better price realizations as the price of crude, gas oil and other derivatives have increased. The EBITDA per KL after forex adjustments fell by 81% year-on-year in the quarter to reach 732 rupees per KL. Here we had an impact of higher priced inventory as well as the lower volumes. However, we expect the pricing to improve, as I mentioned earlier, to be a lot better from Q2 onwards, and we should be able to make a positive contribution at the end of a 6-month period in the oil business. With the bulk of our higher price inventories that have been consumed, we expect very little of that impact to be there in the second quarter. In terms of cables, our revenue declined 37% year-on-year and came in at 250 crores, mainly due to the subdued demand in the domestic markets. Export revenues increased by 109%, so they were basically double of what they were a year ago, contributing to 27% of the revenues of the cable business. We saw a recessionary trend in the market for all varieties of cables, as well as various payment issues from customers, especially from the EPC and the solar segments. There was postponement of deliveries to railway coach manufacturing facilities, as I mentioned earlier, as they took a lot longer to ramp up, maintaining the safe distancing and protocols that have been put in place. The power cables continues to be highly competitive, and we are focusing currently on exports, especially to regions with high Chinese cable market share. There seems to be an underlying current which shows more openness from global customers to look at alternate suppliers to their Chinese supply chain. We expect this to open up opportunities for Indian manufacturers like us. We have already started engaging much more intensely than in previous periods with overseas buyers. However, we feel that this will take some time to fructify, but as we stay focused, our export business will continue to grow. There was lower demand from the railways, defense and solar sectors, as I mentioned. However, in Q3 and Q4, we expect all of these sectors to pick up. The demand from the telecom side continues to be slow, primarily on account of a lot of issues that BSNL is having. However, having said that, there has been some amount of increased demand from cable operators and some of the telecom operators due to the work from home bandwidth demand that is picking up. EBITDA margin post forex adjustment in the cable division came in at 2.9% versus 13.2% in Q1 FY20. Our cable division otherwise has higher fixed operating costs. We have taken several steps in terms of right sizing the manpower and readjusting manpower to the lower demand which is expected in the sector. So the benefits of that will start accruing from Q2 onwards. So summing up, we hope that the worst is behind us, though there are still intermittent state level lockdowns disrupting the recovery. We have already undertaken, as I mentioned, several cost reduction initiatives that should start reflecting from the second quarter and have their full impact from Q3 onwards. The demand, we feel, will still take some time to revive, as the economy is projected to contract at about 9.5% this year, especially in the domestic markets. Our overall feeling is that our export revenue for FY21 will be higher than for FY20. We continue to focus on collections, order profitability, and we have been keeping a very firm eye on our financial health. We have been exploring export opportunities, as I mentioned, especially with the transforming landscape towards renewables. This transition we have mentioned before is very positive for infrastructure building providers like us. We reiterate that many overseas governments are including power infrastructure and renewable projects as part of their overall boost to their economies and to increase local employment in their countries. So to sum it up, we expect the domestic market to still be slow and lower than in the previous year, though it should improve in Q3 and Q4. The fundamental demand drivers for our products, however, in the medium term remain intact, which are primarily demand for renewables, railway electrification, thrust from various governments both in India and overseas on infrastructure development. We believe that Apar should emerge stronger and experience accelerated growth post the COVID-19 recovery. So with this, I come to the end of my formal comments. I'd like to thank all of you for joining our conference call. Wish you all good health and open the floor to questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Pratiksha Daftari from Equitas. Please go ahead.
Thank you for the opportunity. Okay, so my first question is for the conductors division. What margin expectation would we have for H2 or probably part of the remaining part of the year, considering that there will be some amount of COVID expenses that could be additional expenses that could be recurring, and also in the annual report you have mentioned that you expect certain margin pressure because of lag in ordering and competition. So if you could just elaborate on that and also give some flavor on the margin expectation. Secondly, if you could break up the order book, how much of it is for HEC, how much is for CTC and copper conductors, and what is the execution period that for the current order book?
So in terms of the H2 expectation, we see things improving compared to what we saw in Q1. Already Q2, we are seeing signs of improvement over Q1. And we hope that a lot of the demand which in India, it's got delayed and tenders have been delayed. At some point during Q2 and early part of Q3, those businesses will get finalized and then the orders will start getting placed for delivery in Q4 particularly. So there may be some impact in Q3 also because of the various delays which have happened due to the tenders and the government concerns which have been going a little slow, in placement or opening of the tenders. So that is as far as the demand in India. The demand outside India, we expect to continue, and we hope that we will be back as per the normal situation as was in the past prior to COVID situation. So that is as far as the exports are concerned. The railway copper side also has been somewhat impacted because the tenders have been postponed quite a bit during this entire COVID period. And that also will result in less demand in Q2 and Q3, but in Q4 things should pick up again. The high efficiency conductor and OPGW business, we expect that to improve, especially because the tenders have been, finalized and part of it is getting ordered out already. So we hope that in H2 we'll have a much better HTLS and OPGW business. And now, if I may request Mr. Diwakar to add anything more.
High efficiency conductor order book is about 13% of the total order book. and copper conductor order book is about 4%, and the quantity of the order book will last for close to about 6.5 months.
Also, Mr. Devadkar, the OPGW is around 6%. So there's a lot of the delayed OPGW lines which actually had come through pre-COVID, and now that is going on in terms of its execution.
Correct.
Okay. So OPG, how would margins for OPGW conductors compare? Would it be closer to HEC or would it be more closer to conventional? And also, what kind of bid book are we seeing right now? Like, considering that the T&D sector has seen 10,000 crore plus orders, so what kind of domestic bid book do we have right now?
The margins are in between actually. They are better than conventional conductor, but lower than high efficiency conductor. We don't give margins for different segments of conductors within conductor. The second question, I think, what is that actually? Mid book means? I have not understood.
You see, there are number of this TBCB bids. I think 29 numbers are there in the domestic market. So in that sense, even in the COVID period, the tenders have been filled up and submitted, but they may not have been finalized and they may be somewhat delayed. So we expect that when the tenders do get finalized, maybe in October time frame, then a lot of business will be coming in, and it's possible that the industry at large would like to catch up on the lost time. And the period for completing those projects is a little tight. We knew that from before in the tender itself. So we are hopeful that the same requirement stands in spite of the COVID lingering issues, and hopefully the industry will gear up to try and get that put in place. So those are with respect to the tenders which have been given, and not yet the orders have been placed. But in terms of order pending situation, we have close to 49,000 metric tons of export and about 6,000 of deemed export and about 23,000 tons of domestic conductors.
Okay.
This is roughly 6 months, a little over 6 months of our annual capacity.
Okay. And on the oil segment, so Hamria, this quarter we saw that the utilization was 55,000 KL, 55%. So that's 55,000 KL. And in the last quarter, you had mentioned that you all have shifted some order and executed some orders from Hamria because of the lockdown in India. So how much of this 55% is more on a sustainable basis, and how much of it could be just because it was shifted from India?
So we expect the utilization this year to be actually much higher than 55. It was 55% in the first quarter, and the constraint really didn't come from our ability to produce and dispatch. But, since the month of May globally was shut all over the world pretty much. So what had happened is that once shipments started going out in April, most customers around the world asked to hold shipments because the ports were congested, and then they would obviously end up having to pay significant demurrages, because nowhere around the world were demurrages being waived. Even in India, there is still a lot of disputed cases going on the demurrage waiver. So what has happened as a consequence is that some of them got pushed out into June and July, and we are seeing that many customers who we were trying to push to move to the Hamria supplies, because we had better logistics there, preferred to continue to buy from India, just given the fact that they had all the history of supply. But with the pandemic having shifted them there, you continue to see the orders now being executed from there. So I would say it's a longer term trend, where we've actually added more customers. I don't have the exact number, but as a trend, more customers have now got added to Hamria who were earlier resisting to actually supplies from there.
Okay.
And given the current situation that we see from that plant, we will see, as I mentioned in my comments, we have a good supply that we did in the month of June, and we continue to have a good supply situation for July, August, and September for this Q2.
Okay. And lastly, on cable division, considering that we're not expecting much demand from telecom, and also there are collection issues that we are seeing in solar segment. So where do we see opportunity in cable for this year, and how big is the opportunity for the new product, that MVCC cables that we have launched? And what would be the application for this cable, MVCC cables?
So I'll answer both the questions. In terms of the solar sites currently are under a lot of stress because there was a period where they couldn't get stabilized in terms of restarting the work. There's also a little bit of a cloud hanging given the fact that a lot of solar cells are imported from China. But having said that, our solar business includes solar EPC players like Sterling Wilson, who are doing a lot of projects even outside India. So even though they place the order in India, the cables are physically going outside India, which are not counted as part of our export. So we do see that in the second half, some amount of demand on the solar side also picking up. If you ask me in general, we will see the railways and the defense not higher than the previous year, but their activity is starting to pick up. A lot of manpower is back in the plants. It's just that they took a lot longer than private companies to get up and running. We have a stronger order book on the harness side, where just rather than supplying cables to the coach factories and the locomotive factories, we are actually building the whole harness and supplying it to them. So the harness sales will be higher. We've already got some orders in place, and we are well placed on some of the tenders which have opened but not been finalized, which will happen in the second half of the year. The medium voltage covered conductors are actually a very safe form of conductor. So because they have an insulating layer that runs on top of the conductor, it becomes safe for places especially which are in forests, national parks, and in congested areas in the cities, where when they're trying to upgrade a line to a higher voltage level, and the line is too close to a building or a balcony of a building. So it's a relatively new type of product, and it's now rapidly gaining acceptance, from various transmission and distribution companies. So again, it's difficult to, it's exactly like the way our HTLS was maybe 3 years ago. So it's a much more technology advanced product, and we've been the first and largest producer of that in India. Our expectation is that it'll grow, but difficult to just put a number at it. Many tenders are being discussed, and we've been having a lot of Zoom calls with various engineering departments of utilities for them to start looking at speccing the product for tenders.
Okay. Okay. And one last question, if we could get the breakup of the non-fund based borrowings that we have, the total borrowings, and how much of it is LIBOR linked and how much of it is domestic.
The LC with interest total is 1465 crores. Out of that, 682 crores is LIBOR based and 783 crores is domestic. And the borrowings total is 346 crores. Out of that, 220 is long term and 126 is short term.
Okay, thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Nimish Shah from MK Investment Managers. Please go ahead.
Yes, sir. Thanks for the opportunity. Sir, my question is on the cables division. Last quarter we had a few orders where the final product was lying with us because of there were no approvals for the product and we had incurred all the costs. So has that sale happened this quarter, or it is still the approvals are still pending for those orders?
So most of the supply has already taken place, and that's the reason why if you see on a year-on-year basis, the cable division revenue still came in at 63%, of what it was in the previous period. Though manufacturing at the plant started only at the end of May, by the time we got permission to start manufacturing. So we had permissions to start dispatching from the end of April. Having said that, there are some project sites where there is still some product which is backlogged and lying with us, because those sites have not really been commissioned properly. See, one of the issues that has happened in the last few weeks, particularly, is that the virus has actually moved to rural areas, and the way some of the smaller towns are reacting to a single case or two cases of COVID, happening even on a project site, is that they want to shut the whole site down and quarantine everybody for a couple of weeks. So these are impacts actually which are hitting our customers, which are EPC contractors and things like that, which is resulting in, some of the supplies being delayed and the offtake getting a little bit slow, or deferment of production, etc. taking place. So these have been some of the challenges which are there. As it's moved out of the cities into the rural areas, the response from the rural areas has been sometimes a little bit more irrational than one would imagine. But primarily what we had as of the end of March has been dispatched.
Okay. So the dip in the margins in the cables business, is it primarily because of negative operating leverage?
It's largely because we have picked up the operating cost other than power for pretty much the entire quarter. So even if some of the contract workers and others had to be reduced, we have obviously made sure that they were compensated for that quarter and then let go. Okay. So as a consequence, you've had significantly higher operating costs. We also have made sure that the people who we wanted to keep through the entire quarter and who are very skilled manpower, they were paid all the way through the quarter, even though they actually hadn't worked. So in that sense, it's not a comparable situation, because the operating costs are relatively very high for the production that has been taken out.
Okay.
But you won't find that repetition happening in Q2 and Q3. There is some operating leverage negative in Q2 because we are still running only at 65% to 70% capacity on the cable side, but we have reduced costs as much as possible.
So should we expect margins improving from Q2 onwards to our normal levels?
We don't expect it to come to the last year we did 11, upwards of 11% as an EBITDA. So whereas in the first quarter, it was only 2.9%. So we would expect that to improve certainly above 2.9, but not get to about 11.
Understood.
It'll be somewhere in between, depending on finally what dispatches take place by the end of September.
Okay. And one more thing on the conductor side. So this one-time expenditure of 16 crore. So is this purely one-time and not 7? So can you just explain what this 16 crore exactly is? Again,
the breakup of 16 crore is out of that about 3.75 crores is because of the price variation loss in our copper railway conductors. Then there is about 4 crores is because of the overheads, the manufacturing overheads and the EPC overheads. And there was some small price negotiation which happened for an existing fixed price contract. So that is about 0.5 crores. And a major 7.53 crores is a duty-free. Actually, for our exports, we can get duty-free material actually. And the duty component is close to about 10,000 rupees per ton. So that duty-free material, there is a backlog of, for the quarter, there is a backlog of about 7,500 metric tons. So 7,500 metric ton into 10,000. So 7.53 crores. And that will come back actually. When we will consume the duty-free material, we are allowed to bring the duty-free material and consume it for domestic actually. At that point of time, it will come in the profit and loss account.
Okay. Understood.
Okay.
That's it from my side. Thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Sachin Shah from MK Investment. Please go ahead.
Hello.
Yes.
Hello.
Yeah. Good evening.
Yeah. Good evening, sir. So just want to check. I know announcement that the government had done in terms of releasing the payments to the discounts of almost 90,000 crore. But from the data, what we see, they have only released about 18,000 crores or so far. How does it impact us in terms of our business demand, tenders, or whatever, in terms of our dispatches? And how do you see it for the next 12 months for our business? Because it's been almost 2 years that we have been challenged. There are a lot of headwinds in our environment from the customer side or the overall sector side. Are you seeing any sign of hope of things turning around?
So this beneficiaries are mainly the distribution companies. And in our conductor business, we don't directly deal too much with the distribution companies. There's definitely an indirect impact on EPC clients who are dealing both with the transmission and the EPC companies and who are our customers.
Distribution.
The distribution companies. So accordingly, we hope that as this full 90,000 crores come into the system, then that cash flow will come through, and that will improve the demand for us, because at times we are restricting our business to some of our clients, EPC clients, who are not able to open LCs in time, and even transformer manufacturers who are dealing with the state transmission companies. So in that sense, it will be an indirect benefit to us once this cash flow comes into the system. In terms of fresh demand, I doubt very much if the distribution companies will have that much ability to fund new projects. This may be more like paying off the old dues, this 90,000 crores. So in future demand, again, we are hopeful that the government of India, central government, will have to help out the distribution companies. Having said that, our main work in Apar is more with the transmission companies, where there is not too much dependence on funding from the state governments. It is more to do with the central government funding and also with the private sector.
Okay.
So actually there is some impact, as Chaitanya mentioned, the impact will not be there on our conductor division. You will find some amount of impact happening in the cable business, but on the cable business we focus only on a few distribution companies. So our largest customer for distribution are the various discoms in Gujarat, who have been profitable, and they are not actually having any of this problem of paying for the power that they bring in. In addition to that, we have a focus on certain circles in Maharashtra and Karnataka, particularly in the cities, which is cities like Bangalore, where again the discom is fairly self-sufficient on cash, largely because they have a lot of commercial and industrial clients.
Okay.
So there will be an impact over there, without a doubt, but we've restricted ourselves in terms of who we deal with, and it's primarily for this reason that we have been focusing a lot more on the export side.
Right. So since you mentioned about obviously on the domestic side, I would like to, I take it that it's going to be tough for at least the 1 year, FY21 at least, looks like. So, if I see the full year FY20, I think our exports was almost 35% roughly of the total revenues. And of course, first quarter has been even higher, but first quarter domestic was a major down, so I wouldn't consider that as a base. But would you have any thoughts on how do you see the exports overall of the total revenue that you would like to have in the next 2 years or so?
So, I'd just like to point out that the percentage is higher on both counts. Absolute export that has happened is also higher in the first quarter than what we did in the first quarter of last year.
Right.
Besides that, obviously, the percentage is very high. It's over 50% if you take, for the company as a whole.
Right.
We had foreseen the issues, as you rightly pointed out, there have been headwinds in the discom side for the last 2 years.
Right.
So 2 years ago, we started actually focusing on, and if you go through some of our transcripts of previous calls, we have been focusing on the export side in both our conductor as well as cable divisions. And in our specialty oil division, export has been anyway a thrust area given that we built a facility outside India.
Right.
So there will be subdued demand on the domestic side. We hope to make that up with export. And as I also mentioned here that the number of inquiries and serious discussions which have been happening with global buyers has really picked up, post the COVID pandemic. So whereas, as I mentioned in my opening remarks, we don't see them just shutting out Chinese suppliers, but there is a real move in terms of wanting to look at good alternatives to them. And I guess as we establish our trust and credentials in terms of supply, there will definitely be a shift that will take place.
Right. And in terms of opportunity for us as a company, can exports be, say, I'm saying next 3 years, 4 years down the line, and if I take a normal domestic business that we did, say, in FY18, FY19 or FY20, we just take an average of that, can exports become bigger than that number in the next 3 years? So I'm saying, can exports be more than 50% even when the domestic comes to a rupee?
It could very well be. And I mentioned this in my opening remarks of today as well as, in our last call which we had with our annual results, that even pre the pandemic, there are many countries which had previously saturated their transmission and distribution infrastructure, countries like Australia, Germany, the Scandinavian countries, where today new infrastructure is coming in place because they are building renewables.
Right.
The location of these renewables is quite different than where their thermal power plants were located or their nuclear power plants were located. So as a consequence, there is this new infrastructure spend which is taking place.
Right.
We have already started approaching utilities and EPC companies in all of these geographies. So this move actually started more than 2 years ago. And what we personally feel is that, part of the expenditure which is being done by the governments to improve employment, etc., is going into infrastructure. And a portion of that infrastructure is accelerating some of this change over to renewables. So, depending on how successful we finally are in picking up larger market share from overseas utilities and EPC companies, our export demand is definitely going to grow, but it may exceed 50%.
Right. But in terms of getting the product approvals with this new customers or some of the other approvals that we will need to get with them, is that a very long gestation process, or it happens fairly quickly in terms of they approving us as their vendors or core suppliers or something?
So it is a long process, but the good news for us is that a lot of it was started much before COVID. So we had people that have come in and done inspections of facilities and, asked for certain type test certificates and all that. So because we started this process a couple of years ago, right now what we are trying to do is we are trying to push the process as much as possible, over Zoom and Microsoft Teams calls and things like that.
So would you say that good part of that process in terms of at least the approvals and getting ourselves empaneled with them is we are at the fag end of that? Would you say that?
I wouldn't say at the fag end of it, but in some cases yes, but it's already progressed. So it's not that we are making a cold call to a utility today saying, hey, introducing ourselves.
Yeah, no, I'm sure. But
so that the process has happened. The other interesting thing is that a lot of overseas customers have also now started accepting inspections which are being done, over the internet.
Okay.
So online inspections, not only of product but even facilities. So we send them an outline of what the plant tour is going to be like, and then take them through the whole plant tour. and there's a Q&A live that goes on, through the whole process.
Okay.
So, it's only the Indian government entities that have been a bit slow in terms of adapting to this. Most of the private enterprises moved pretty quickly, both in India and overseas, to figure out a way of dealing with this pandemic.
Right. But any sense would you have that, say, next 2 quarters, 3 quarters, in what time frame some of the large customers' empanelment can be done, and then, we can start thinking about bidding for those businesses or those kind of things?
So it's difficult to put a timeline on it. Different utilities, as Kushal said, we are at different stages of the whole process. In some cases we were like almost 99% done, and there was 1% left, and the person was practically on a flight, and we had to tell them that now please don't come to India. It was in some cases like that, and in some other cases where we have reached like 90% plus of the journey. And, again, there are certain formalities left, which we are trying to get them now to do the virtual plant tours and, get through with the testing part of it.
Okay.
So but the bottom line is it's difficult to predict, like what you're asking in the next 1 quarter, 2 quarters, I think that's still a little bit away. Maybe by the end of the year, you'll start finding, a little bit more predictability starting to come in. All I can say is that there is fair amount of activity which is happening.
Fair enough. Okay. And just last one question, that on these railways was in the domestic market in the last 1 or 2 years, railways has been one of the incremental growth drivers, or incremental demand has come from railways quite significantly, I would say. Now that this year, obviously we can see that the railways revenues itself would have dwindled quite significantly with so much of lockdown. Do you think that would change their capex budget significantly for this year or the year? How would it play out?
No, they may not have a reduction in their budget. Their plans are still like the 7,000 route kilometers which was talked about. But from a practical point of view, unless the tenders get finalized and they start allowing the work on the ground to happen, yes, practically we may see a reduction in the actual demand, which we talked about earlier. But the goals remain the same in terms of the electrification, what they want to accomplish. So it may get pushed back by maybe 6 months due to this pandemic and lockdown.
Okay. Great. Thank you and all the best. Thank you so much.
Thank you. The next question is from the line of Dhiral Shah from Phillip Capital. Please go ahead. Mr. Shah, we are unable to hear you. Can you move to a better reception area, please?
Yes, hello.
Mr. Dhiral Shah, your line is in talk mode. Kindly go ahead with your question.
So what is the current capacity utilization across the plant?
Are you asking for the conductor business?
Overall, sir. I am asking overall, sir.
So in general, we are the cable business is running at around 65 to 70% utilization. Our specialty oil businesses, I don't think utilization percentage is actually the bottleneck. So in terms of demand, last period we were at about 70%, for the month of, about 60% for the quarter. And in this quarter, we expect to be at around between 75 and 80%.
Same for the conductor.
And for the conductor also will be around 75% also.
Okay. And sir, when you expect that overall export, may touch around 50% in next 2 to 3 years, so thus it will help us to improve our margin?
Yeah, actually, in general, we are focusing less on conventional conductors and more on, all the remaining, more value-added products. So that is a conscious effort, which is there even in the domestic market. So if you see besides the conventional conductors, we are having specialty rods. We have the copper conductors now. We've got the copper transpose conductors for transformers, the HTLS or HEC, which is a high efficiency, and OPGW. So our conventional conductor percentage itself will come closer to 50% of our revenues. And then as far as the export side is concerned, there will be more conventional conductors that go in, just for evacuation from solar sites and things. But those margins are better than the conventional conductor margins which we have in the domestic market. So going forward, we've been very clear that we don't want to add more capacity. We want to only concentrate on the mix of products that we make, both geographic as well as product mix.
Okay. And so export will have a higher working capital cycle, or it is the same as the domestic cycle?
So we have to import duty-free raw material. So to that extent, there are a little more lead time to get the raw material. In terms of the finished product movement, also we have sometimes like an inspection lot that goes out. So we have generally a little more on the finished goods stock, but it is nothing very significant, both these two components.
And it's easier, the receivables are usually faster. So even if there are extended terms on letter of credit and stuff, there are discounting lines available, financing lines available, etc. So usually payments on the exports are more secure than, in terms of time, are more timely than in the domestic.
And the interest cost is much cheaper in the case of the export because we can do LIBOR-related borrowing because there's a natural hedge. We are selling in dollars and buying the raw material also in dollars.
Okay. And sir, in our oil division, do you have now higher kind of inventory because of we have seen an impact in Q1?
No, we actually have reduced our inventory levels as we move into August. Meaning, so July levels are lower than what they were in June, and we don't have anything in excess. The problem which was there was that the pricing levels were relatively high because these products came in based on pricing in the month of February, March, and they arrived during the lockdown when the price of oil crashed. Now with demand having started getting restored to a very large extent, at least on the fuel side, I think in most countries it's now at close to 90% levels other than aviation fuel. The prices also of crude oil as well as gas oil, etc. have moved up. Base oil prices also have started moving up. So we don't have a problem. In fact, we will gain from slightly cheaper inventory to compensate for the more expensive one that we had in the previous period. So that's the reason why I am making a statement saying that as far as the oil business is concerned, the second quarter's profitability will be relatively better because of these factors compared to the first, and overall 6 months we should be having a positive number.
Okay. And so one last question. So when do you expect the overall margin to be at pre-COVID level?
I wouldn't be able to take that guess.
Maybe by Q4?
Your guess is as good as mine.
Okay. Thank you for that. Yeah.
Thank you. The next question is from the line of Himanshu Upadhyay from PGIM Mutual Fund. Please go ahead.
Yeah, I had a question on the conductor side where we have clearly stated that we want to focus more on high margin business. Okay. Can you elaborate on the opportunity size for that business and how high can the margins are? And how is the rate of innovation in that business means? Do we think that every 3 to 4 year more and more products are coming which are at a higher value addition type of products, and where are we in that scale means? When we are thinking that we want to have a higher or better margin and more difficult business, how difficult is to get into a more complex product on that side means? Can you throw some light on those things?
Sure. So, for many decades, in the whole world, people were using what was called the conventional conductors. And then maybe about 7-8 years ago, the HEC or the high efficiency conductors, which could transmit like almost double the amount of power, those started getting introduced in India and globally. So those products have far significant technology involved, not only in the manufacturing but also in the application of it. So what we do is we actually have a service component where besides manufacturing it, we are also doing the reconductoring of that. So I would say there are certain barriers to entry, and there are not many producers in India as well as in the world who have been able to manufacture these type of products. These are growing in popularity, and slowly as the different countries need to upgrade their systems, either the old lines have now got corroded or they are now too congested and they need to have them replaced by new lines, and they don't have the space to put up parallel lines, then they simply remove the old lines and put up these new high efficiency conductors. So there are significant barriers to entry for these new product lines, for the new generation conductors. Then in terms of the steel, which was the earthing used in the transmission system, that is getting replaced with the optical fiber ground wire, or what we call the OPGW. So here again, there is a component of manufacturing of the optical fiber unit as well as the conductor unit. So because in Apar we have both the cable and the conductor business, we could manufacture this product. Again, there are not many manufacturers in India who are able to make the OPGW type of conductor. Then the copper railways conductor, there are two parts to it. One part is what is called the contact wire, the other is called the catenary wire. The catenary wire again is a slightly complicated product because there are certain alloys along with the copper. So the margins for products where the competition is less is definitely having better margins. And then the last product line is called the copper transpose conductor used in the transformer industry, where again it is a much more sophisticated product requiring a completely air-conditioned environment, and there are very severe product requirements, and therefore there are fewer producers, relatively higher capital cost also compared to other type of conductors for the plant and machinery. So all the new product lines, whatever we have got into, are ones where there is basically more technology involved and there are relatively less players. So definitely the margin profile for all these product lines is better. The only thing is that for most of these new products, there is a certain time frame before we can get the approvals, and so we are not up to the full production capacity, and we have been actually incurring the cost of the investment, the capex cost we have incurred, so the depreciation and interest costs, while the ramp up is happening simultaneously. So these new products are now slowly, coming to help in terms of overall profitability. But as we have grown in these products like high efficiency conductor and copper railways, we have also got into other products like OPGW and copper transpose conductors. So as these also come to a certain critical mass, then the overall business will show much better results. In addition to that, the specialty rods also is another opportunity we have pursued, and especially in the export market, we find that the volumes are very large available in terms of the opportunity. So here again we see that there is a growing prospect for us, given that we already have the infrastructure in place at our end, and we are trying to gain more entries in various export markets for these products.
So one more, so the basic thing is the high-end product, the market size is also increasing at a better pace than the conventional conductor, and that should. And how difficult is it to copy those products? Or let's say there are industries where we say that in 3 to 5 years the other people are able to copy and get into those businesses. So what would be your thought process in the products where you are? How large is the leeway for you, or the time frame where you need to capitalize on whatever investments we have done? And is innovation still happening on more products on those sides? Can you elaborate on that thing? And what can be those innovations? And where would we be in the whole cycle of innovation if we want to upgrade ourselves?
Sure. So in terms of the innovation part, if we can address that first. Basically, because in the high efficiency conductors, there is a fair amount of work already happened in the last few years. We have already done that work, in terms of the various special alloys which are required to manufacture, and also got up the learning curve in terms of the stringing abilities. So my sense is that there won't be that easy for even in 5 years down the road for the bulk of the producers in India to try to copy the same thing, because it needs a totally different, mindset and also a large amount of capex. In conductor business, we have incurred maybe 350 odd crores already the last few years, which most of the companies in India may not have the wherewithals to be able to do that. They are still struggling within the conventional conductors itself to try to make the transition to get entry into the export markets. Leave aside all these other type of specialty products. So the innovation will be happening more in terms of solving ground reality problems in terms of how the stringing technology can be improved and the speed of implementing the projects can be done. So our focus is on that, because we see that there are various different opportunities in India requiring different terrains and different challenges and how to resolve those issues. So we are working more in those lines for, in the innovation front. And it's like, even if others are, trying to copy the product, but if they don't give the solution as a whole, then again the utilities may not be interested to buy from them, because no more that, like in the old days, Power Grid used to buy the conductor separately. It was a commoditized kind of product and simply give it to a EPC party to do the stringing of the conductor. Now for the HEC or the OPGW and other such products, the client is looking for the entire solution end to end. So if the other conductor people are not yet geared up, I don't think in 5 years' time they will be able to also manage this, because we started off maybe 10 years ago in our R&D and then slowly got a few pilot projects and then progressed from there. So my sense is that it will be difficult for others even in 5 years down the road to kind of, replicate what we have done. Besides not having the financial ability to, put in that kind of capex.
And this business would be growing at what rate, or the market size would be growing at what rate globally?
So, the high efficiency conductors, they have a low base relative to conventional conductors, because the use is more on reconductoring the old lines currently. And in some places where, the planners of the infrastructure have realized that they will not have the scope to put up additional lines, then upfront they are putting up the new lines also with these type of conductors. So generally, although I don't have the exact number, but generally we are seeing that this growth is in upwards of 20% per annum globally, what we are seeing. And in India and around India also, we are seeing that, there is a good offtake now for these various type of products. The railways, which is another segment, there also government has a fair amount of plans to replace some of the diesel locomotive system with the electric driven ones. So they have to electrify the whole system. So a lot of new tracks are being put in place, plus the old tracks are getting substituted so that they can be run on electric system. So here again we are seeing there was a quantum jump about a couple of years ago, but in times to come also we see a growth of about 5 to 10% at least that will happen. There are certain bottlenecks we see on the ground in terms of the EPC on the railway implementation side. But here again, I think a lot of the traditional transmission EPC companies have now ventured into the railway segment. And with the entry of all these big parties, I think there will be a lot of more speed of implementation on the railway side also in times to come.
And in terms of competition, would Chinese be major competitors to us? And will it help us, means when you stated in your opening remarks that there is, or our people are looking at moving out of China also, or diversifying the base. So in those products, how is the competition mainly from? Is it Europe and American companies, or it is Chinese players are also there in the high conductor space?
There are one or two companies which are from China. But again, in certain geographies, we are seeing that the preference is not to buy so much from China, at least to reduce their dependence. So accordingly, we are seeing that now we have been getting more reception from some of these countries to approve our product, and accordingly we may have a better chance than we had earlier. Having said that, the Chinese governments in the past had signed up a lot of the foreign trade agreements in some of these with some of the countries, so they had certain benefits over Indian exporters because of the tax advantage. But that is not very large number of such cases. And even here, now with the COVID situation and certain trade war type of situation, we see that Indian exporters such as ourselves may have a better chance than we had in the past to compete with them in those so-called countries where they had a benefit over us.
Like in Australia, for example, the Chinese have a 5% benefit. 4% benefit. So that's something that is likely to come under review now, given the fact that the two countries' relationships have been a bit strained, starting up with COVID. So these sort of things are there. It takes a little time for some of these actions to happen, but it's moving in a certain direction.
Okay.
Yeah.
Thanks. One last question from my side. On the transformer oil again, where we are the fourth largest player globally, and overall oil business also, what are the opportunities you are looking for improving the margins business, and again it's a much more diversified product. Are there niches where we can enter or get better margin, difficult to copy business, or to get
we already have. We are the upper end of the spectrum, which is the ultra high, the EHV and UHV, which is ultra high voltage transformers. We have a very strong presence in that segment, both in India, and we are also exporting the products elsewhere. It's the transformer oil which goes into the distribution and smaller transformers, which is under usually much more pricing pressure. So we cover the entire spectrum on the transformer oil side. So and in fact, the transformer oil business will continue to grow as more and more of the new electrification infrastructure comes up. Not only from renewables, but even later on, if you have electric cars and electric buses and things, the moment you need to have an electric charging point, you need to have a transformer in the back end to be able to handle the power coming into the installation. So I think from that standpoint, that's the reason why we mentioned that all our product lines, we don't see any impact from the COVID period, and generally the trend is for power infrastructure to grow.
Okay. So my question was also on, we are in rubber chemicals and industrial oils, rubber oils and industrial oils. So is there anything we are doing on those products also, or how are you looking at for demand for those products, and what would be the revenue contribution from else than transformer oil?
The transformer oil, Mr. Devakar, is 43%, right?
40% is transformer oil. Rubber process oil is about 9%.
So we've transitioned to about 40-odd% for transformer oil. The rest of it comes from the remaining basket.
And industrial and auto is 23%.
Okay.
Yeah.
Okay. Thank you from my side. Yeah. Thanks.
Thank you. The next question is from the line of Pawan Nahar from an individual investor. Please go ahead.
Yeah, good evening, gentlemen. Thank you so much for the answers, and it's really heartening to see all the amount of activities and the products-related stuff that you've answered. I am just left with one question. If you can elaborate about the opportunity in specialty rods and, what exactly is this? I'm sorry, I have missed this particular one.
Yeah, in specialty rods, there is one component which is called the mechanical alloys, which goes not in the electrical industry, but in other than electrical industry, which is part of the 5000 series of aluminium, which is an alloy of aluminium along with certain other type of components. So this is one type of specialty rods. Another type of specialty rod is, going as a replacement of copper in some of the house wires. Although in India it's not picked up, but in a lot of other foreign countries, the utilities there and the authorities there have allowed flexible aluminium alloys to replace the copper. So this is a very big market, and this is another example of what we have started doing in terms of specialty rods.
Got it. Thank you so much and best wishes.
Thank you.
Thank you.
Thank you, Pawan.
The next question is from the line of Naveen Agarwal, an individual investor. Please go ahead.
Hi, this is Praveen and not Naveen. But my question is, right here, in the last few years, we have introduced all these products, which, keeps us different than the competition. But somehow, the same level of technical, whatever we have done on the technical side has not kind of, has materialized in terms of the bottom line. Our top lines have grown tremendously well over the years. It's something we have not been able to, capture the same opportunity in the bottom line. So, is there a thought process where we want to focus on how to get our return ratios up and going forward? Is there a thought around that?
So actually, some of this had, there are, if you see the biggest component that has been actually dragging profitability has been the cost of interest. And we had two parts to it. One is, a whole lot of investment has already gone into the business. So as the utilizations of all these projects is increasing, you will find that then the interest cost as a component will fall. Secondly, in the last 2 years, there's been an expansion in terms of the amount of days outstanding, from various EPC customers, from utilities, etc. So we've been taking a number of actions to actually curtail that. And in fact, part of the reason for coming up with these new product lines are that they address the competition level is a bit lower, and in some cases, you end up having better payment cycles, like in the case of the railways, the rod business, etc. We personally feel that, as we get out into the years and the utilization increases, also the interest rate regime is becoming a bit more benign. So we've seen just in the last 6 months, LIBOR-based interest falling by about 1%, and domestic interest falling by about 1.6%. So, as you find, and we are also now looking at much more fiscal discipline in terms of extending credit to customers. We no longer want to be a secondary bank to them. So, even if our volumes fall on some of our conventional and lower margin product lines, we would prefer that and make sure that the fiscals are in order. So, with a higher emphasis on return on equity and return on capital employed, you will start seeing the profitability improving. And you can already see that actually in the case of the conductor business, the EBITDA per metric ton has improved, if you exclude what has happened in the last quarter.
So that's great to hear. So one other thing, since, we are kind of pivoting towards more exports, and I would imagine that, whatever issues we face internally in our power sector in our country would not be anything remotely similar in those countries. So what would be the, payment cycle, say, in all our three different verticals in exports, say, vis-a-vis domestic? Say in say in the oil, transformer oil segment, if we kind of 5-6 months, if you were to export, I would imagine it would be much, much shorter. So what would be the ratio across the...
So the oil exports, the transformer oil is generally between 60 and 75 days. And the white oils and other products are all 60 days and below. The main thing is that the interest rates are a lot less. You're talking about funding, as Chaitanya had mentioned earlier, in the sub 3% level, that you can, fund the cycle. It's also much easier to discount documents. And the cost of discounting documents or forfeiting the documents for overseas projects is a lot lower than domestic. So the overall component, so one aspect is number of days, but the second one is the amount of finance cost as a percentage of the gross margin that you generate. So that in the export business is lower. So, as you move into FY21, 22, etc., you will find the interest component falling, both not only because of the interest rate but also because of the structural nature of export versus domestic.
That's very good to hear. That's it from my side. There's no other question.
Thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Manish Parekh from Vibrant Securities. Please go ahead.
Hello, this is Lala Ram. My question is on the cable side. What is the a long-term vision where we want to take this business? If you look at the larger picture.
So on the cable side, we've been focusing on two aspects. One is on specialty cables, and that's where we come into cables which are for coaches, locomotives, the solar wiring. We also want to move towards more and more products where we're not just supplying a cable, but we're also supplying a system. So the harness actually takes the cables and you supply a wired system in place. We started harness for the railways. We started harness for the windmill manufacturers. We started harness even for the locomotives. So that's clearly another direction that we are pushing the cable business into. The third aspect is that renewables also require special cables. So in India it's largely solar, but when you go outside India, particularly into the Western world where they don't have so many days of sunshine, wind is a very big component. So we have been focusing on producing cables for the windmills. Previously we started only with Suzlon, but now we supply Gamesa. We've got approval from Vestas. We've got from Nordex, from a whole lot of overseas players. So the non-conventional energy side is another area of focus. So one is the harness and the other one is non-conventional energy and specialty products. The third area which had been asked in one of the questions previously is MVCC. So looking at cables which bring about a higher level of safety.
Got it.
So these are the areas, if you get into just conventional power cables, there are a lot of producers around the world. There are 300 plus producers in India. So it's a mug's game. So ultimately, we need to keep moving into cables where, there is a technology aspect or a design aspect involved. The same thing as what we are trying to do on the conductor side. All the equipment which we have put in the recent years has a very high degree of fungibility. So even though you incur an initially higher capex, it allows you to manufacture multiple types of product. So you see that benefit will show up, as the product mix starts changing, over the years. The capex is already done.
Understood. And when you say that there is some kind of client withdrawal from China and towards India, this would be for which product types?
So it's actually pretty much across the in the case of conductors, the Chinese really compete on the conventional conductor side. We've not really seen them competing globally on HTLS and these sort of product lines. On the cable side, they are very active on power cables as well as the solar cables.
The Chinese one?
Yes.
Okay. So solar could be a big opportunity where we could replace them. That's what you mean to say?
Yeah, absolutely. We've already been bidding on various projects all over the world. And over the next several months, I think you will start seeing some of that business coming through.
Got it. And one of the things which you just mentioned around in your business economics, wherein you said that when you compare your finance cost, discounting cost with your gross profit, I think that has been something which has taken a lot of the profits away. So I understand that you are trying to bring that down, but do you think that the overall interest rates themselves remaining low which is actually not a function, which is not something which we can control, is the only way where we could improve the profitability? Or is there a structural way wherein the way we do the business itself can help that and make it more sustainable?
One thing is that, as we discussed, we have put up a fair amount of capex for new products. So as they ramp up, automatically the revenues will go up, but not proportionately the interest cost. So that is the main driver for us, which will relatively bring down the cost of interest per ton of product.
Also, we've had extended number of days. The whole distribution and the whole Indian power scene has had a very bad credit situation in the last 2 years. We've been coming to grips with that. We've cleaned up a whole lot of old collections and things, including during this pandemic period, etc. So structurally, fiscal discipline is something that we are putting in place. And we have been focusing now. We've already incurred all this capex. We're not interested in just growing capacity and growing the top line. The focus is more on concentrating on the product mix and the geographic mix that we get after. The interest rates being lower is something that obviously is going to benefit. Also, as you move towards a higher component of export, that structurally itself is lower interest. So whether the interest rates are higher or lower, there is a gap of almost 4% to 5% in the interest component of domestic business versus export business. And the number of days on both of them are approximately the same. In one case, the receivables are a little lower, and the execution cycle is a little longer in the case of exports.
Got it.
Structurally, you end up having a much lower funding cost.
Got it.
You will see that over the next couple of quarters, the interest burden will definitely in FY21, FY22 seems to be also pretty similar. Interest component will start coming down.
Got it. And one final question is 100% of our business purely B2B, or is there an element of a distribution-led sales?
So we have as part of our automotive business, we have a B2C component where we do distribution of automotive oils across the spectrum, and we have a small component which we have started growing of building wires.
Okay.
So right now the building wire sale is small. We are doing approximately 60 crores a year, but that's slowly growing. Last year we did 20. This year we will do 60. And the target is to try to grow that part of the business. So the B2C component, there is a B2C component, but it's right now quite small relative to the total turnover of the company. Though it's an area where it's profitable and we are independently trying to grow that.
But do you think Apar as a whole, as a group, has historically been a B2B primarily? So to build that B2C, are we sort of relying on internal talent, or is there a strategy which you have outlined?
We've hired people who are from that line of business. The automotive side, we've been in it now for the last 10 years. And we've been growing the retail side of the business, and we are accessing over 10,000 mechanics today. And that part of the business has been growing year on year. On the building wire side, we really launched that only 2 years ago. And so there is a separate team that's focused on it. It's not that existing manpower and staff is being deployed. A new team has been put in place that come from that background.
And what is the brand? Is it Apar Shakti? What is it called, the B2C brand?
So in the case of automotive, we actually have, we distribute the ENI brand under brand and license agreement from ENI of Italy. We also have our own brand, which is Power Oil, which we do in the automotive segment. And as far as the building wires is concerned, we are basically selling building wires which are made out of this electron beam process, and it goes under the brand of Apar Anushakti.
Okay. Yeah. Any numbers on how many distributors we have, dealers, or any numbers on that side for cables particularly?
So for the building wire, so it's only 2 years old. We're starting to build up the process, but in terms of primary distributors, we have about 70 primary distributors today. And we started distributing the product in 5 states. We don't intend to increase the number of states as much as now focus on more deeper distribution in these states. So we do Gujarat, Maharashtra, Karnataka, Tamil Nadu and Kerala at this point.
Got it. And with this entire new theme of electric vehicles and maybe charging stations and all, is there an opportunity for Apar to be involved in this new area? Or any thoughts on that?
So at this stage, we would like to focus only on supplying the infrastructure and the gear that go into that, particularly in terms of various types of wires, oils, etc. So there are different requirements which are likely to come up. See, this whole area is in a very, very early stage. So the product profile itself will change over a period of time. But so we are in touch with all the key players in this. So as it develops, we will make sure that we have our relevant products which fit into that gamut of things.
Got it. Thanks. All the best.
We've also developed an entire set of wiring and harness for electric buses.
Okay.
So we should be receiving our first set of orders for electric bus from JBM, which is one of the primary companies that's building all electric buses for the state transport.
Got it. So this is separate from your railway harnessing, right?
Yeah. So separate from that, you build all the wires which go into an all-electric bus.
So I believe that Madan Sumi is the leader in harnessing for automotive, right? Passenger vehicles. Is it similar to that what you can do in say railways and buses, or
yes,
they're not comparable?
Similar sort of harness. It's a complete frame. It's a full frame that goes with the connectors, so that then instead of doing the wiring by the railway, by the coach manufacturer or the locomotive manufacturer, they just fit their leads into the connectors which are there.
But based on my limited understanding, what I understand is that this is generally a very high entry barrier business, and the OEMs rarely switch suppliers here. So I don't know if I'm wrong here, but any insights on how we have been able to enter these segments, replacing existing suppliers, or is just a new area opportunity which has come? Can you just throw some light there?
So we are not competing with Motherson Sumi because they focus mostly on the mobility, on the transportation, meaning the automotive side. Our focus has been on locomotives. So all the harnesses that we've built are for windmills, solar panels, your railway coaches, railway locomotives, and now we are building these electric wires for the electric buses.
Got it. So this should flow in, say, in a year's time.
We don't intend to compete with a Motherson Sumi or a Tata Yazaki. In fact, they will become our customers as we are actually trying to build e-beam wires for automotives. We've already got the product ready. We've already gone and got approvals from ARAI, and we are now actively marketing those wires with all the players.
Got it.
So our customer will be a harness manufacturer who in turn will then supply to Tata or Mahindra or Suzuki or one of these.
Got it. That is helpful, and my best wishes.
Yeah.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Praveen Agarwal, an individual investor. Please go ahead.
Hi. One more question. In the last conference call, you mentioned something about the prototype which we did for the defense. Is there an update on it?
We are building a lot of prototypes for them because under this Atmanirbhar projects which are now running, So we built a whole lot of prototypes. So I don't know specifically which one you're referring to, but I can only mention that not only number of prototypes are being built, but there's serious testing going on of these also.
So the one I'm referring that there was one which you said that during lockdown the government or the defense came back, which you did some few years ago, and they now came back showing interest that they need something.
So we got an order for some Ether cables for about 75-80 lakhs. So there are small orders that started coming in, but there's a lot of development work still going on in that space, where there's either import substitution. Most of it is import substitution, and some of it is actually import substitution but with a different design, because most of the foreign suppliers want to supply just the standard product which they have, whereas the Indian armed forces have their own ideas in terms of improving on properties of some of those. So we've been working with them on that aspect. So the amount of supply which we are having to the defense in general has been growing. So this year we will do approximately 70 odd crores of revenues which will go into the defense.
And this is across Army, Navy and Air Force, or?
It is for the Indian Navy.
Okay. And how do they, what is the scope here? Is it 10, 20 times the overall scope? If eventually our products do get approved and more products, what is the scope of the kind of products we make in terms of what we are looking to do with?
So it's very difficult to actually define what the market size is on this, because the moment you start dealing with any of the defense organizations, they're quite cagey in terms of the total quantity that's there. They always lowball the number of of installations that will be there. But what we've seen over the years is that you build 10 products and 2 of them are successful, and when they're successful, they're very profitable. So it's very difficult to hazard what the market size is going to be like, because this whole process is picking up steam in recent times, where there is a pressure that is being built that India needs to just have much more sustainability, a much higher local content in all the defense related products.
That's great to hear. So, and all the products, the entire 70 crores of defense, would you classify all of it as import substitution?
Yes, 100%. Because, the original products have all come in from either Russia or France, in things like, in the ships and the submarines and things like that. So they are actually an import substitute, and in many cases it's an import substitute with a design change to suit, whatever the operating conditions that our armed forces are now wanting to adopt.
And at what growth rate this business is growing? I know it's a still small piece, but at what growth rate this business is?
That's what I said, it's difficult. It's grown quite substantially. 3 years ago we were doing hardly 15 crores. This year we will do 70. So it's grown. But what exactly that trajectory will be is not clear, because there are so many variables in this, in terms of finally how much is the allocation to defense, where the priority is in terms of what equipments they want to make, etc. So it's difficult to lay our fingers on how much it's going to be. But since we already have all the infrastructure to produce these sort of specialty cables, anything that comes by is positive for us.
That's good to hear. Thanks a lot. Nothing else from my side.
Yeah. Okay, right. Thanks.
Thank you. A reminder to
We can take another question and then maybe we can wrap up.
Sure, sir. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Manish Parekh from Vibrant Securities. Please go ahead.
Sir, based on the low capex going forward, so can you give us some guidance on how much debt reduction can happen this year and maybe?
Sorry, your voice got cut off a bit. Can you repeat, please?
Got disconnected.
Okay.
A reminder to the participants, anyone who wishes to ask a question may press star and 1. Sir, we have no questions in the
Yeah.
queue.
So then we can just...
Sure. Over to you also for closing comments.
Yeah, so thank you everyone for being on the call and patiently hearing our commentary and through the Q&A. We believe that in Q3 and Q4 things should improve. Q2 of course will be better than Q1. And as we've discussed through the Q&A, there are plenty of opportunities that exist for us in terms of the new product lines that we've introduced as well as in the export markets, which we are pursuing. So we do see a lot of opportunities even post the COVID environment, and the company is reasonably focused on taking advantage of them. Thank you very much, and I wish that all of you stay in good health and remain safe.
Thank you. Ladies and gentlemen,